Hello, crypto. Welcome to another episode of Crypto Rules Everything Around Me, Cream Channel. Follow the cream, get closer to your dream. This channel is created for technical analysis, entertainment, and educational purposes. Nothing I say is financial advice and my opinion only. So, for this episode, I'll be discussing the difference between fundamental analysis and technical analysis. And I will also be explaining briefly on the indicators that I use on my charts, which is the EMA, the difference between EMA versus SMA, MACD, MACDs, RSIs. So stay tuned. Hopefully this will help you understand and learn the indicators that I use. So the difference between fundamental and technical analysis. The difference is fundamental analysis understands the patterns in an entity's financial performance, while technical analysis understands patterns in price action. It focuses on data. Function of fundamental analysis is used for investment-related functions, while technical analysis is used for trading-related functions. So for day traders, hourly traders, technical analysis is for you. For like investments for years and months, I guess fundamentals for you. Fundamental analysis, the relevance of investments that are long-term, focuses on historical and present data. Technical analysis, investments that are short-term, focuses on historical and present data as well. Aim of fundamental analysis is conducted for the purpose of identifying the intrinsic, I misspelled that. Sorry about that. Identifying the intrinsic value of a particular stock or crypto. Technical analysis is conducted for the purpose of identifying the perfect time to enter or withdraw from the market. Okay, methodology. Fundamental analysis helps in the examination of ongoing industry trends, financial data, economic outlook, and performance of competitor companies. Like example right now, right? We have that global pandemic. It just finished, or maybe just finished, quote unquote. And now we recently have that war with Russia and Ukraine. So this goes with the fundamentals. And with technical analysis is used for examining the market psychology and price movements. So technical analysis involves more of like messing with your head. So emotional, you got to learn how to control your emotions. And you got to understand price actions. You got to learn support and resistance to be successful in understanding technical analysis. Data sourced from fundamental analysis, sourced from economic, which what I just mentioned. Like, you gotta be up to date with global news, business wise, what's happening with the world. It all affects everything in the fundamentals. So industry statistics, financials, management, process, and news events. News events is the biggest thing for fundamentals. So when you're a fundamental trader, you rely heavily on news. So you got to be on top of it. When you wake up at 5 a.m., read up on the news, what's happening around the world. And technical analysis, it's all about charts. News events can also impact charts and its trajectory. Let's say we're in a bullish trend, but something negative comes out in the news, like let's say the war with Ukraine. Before it hit, we're going up, and then when the news was coming around it tanked the market. Or even COVID. When COVID hit, it tanked the market, right? So news can still affect technical analysis no matter how accurate you can line them up. News can still affect charts. And indicators for fundamental analysis are people study expenses, revenues on a business, assets, liability, debt equity ratio. Basically, you're trying to, when you're using fundamentals investing in a business, stock, crypto, you're trying to see if they're healthy, if they can sustain their project, if their business is going out of business, if they're going bankrupt. So let's say you want to invest in Tesla, you want to see a healthy spreadsheet, right? You want to see they're making money every year, every quarter. So you got to stay on top of that. If you're fundamental, you look at all those things. So now for technical analysis, you're basically using indicators on the charts, MACDs, the same ones I use, RSI, ball bands, EMAs, Ichimoku Cloud. I first started with Ichimoku Cloud, but I didn't take it further. I found my other way of trading and using my own indicators that work for me. So technical analysis is all about charting and indicators. Okay, so the next thing is I'll be talking about is how to chart the indicators that I use. Okay, so I'll take off everything here, delete that, delete everything, and start fresh. Okay, so normally when you first open a chart, all you see is this, right? Like normally you see volume in the bottom, but I don't pay attention to that. I look for resistance, supports, and whatever. So I'm using Binance right now, but if you use TradingView, look for indicators. So indicators right here. All right, and then I search EMA. Okay, and a lot of people use SMAs. I use EMA because it works better for me, and I'll explain to you why that is. So I choose 4. Press it 4 times, right? Why I choose 4 is because I have 2 for short terms and two for long terms, and I'll adjust them as the way they work for me. There's a lot of tutorials on YouTube or on the internet. Research your own, what works for you, test them out. Test out every indicator to see what works for you. So my first one would be here. I take this off, and then it's 10. The first one's always 10, and my first one is always green. Okay, see, as you can see, the green's there. Second one, settings. Take this off, leave it orange, make it thick as well. And then I change this to 20 days. And press OK. So you see, now you see the green and the orange. These are my short-term trades. For short-term, yeah, price action. And then the last 2, change it to something that pops, right? So yellow for me, and I make the line thick. That's what she said. Yeah, just thick just because it's easier to spot, because the 50 and 200 EMAs are the main indicators for me. Those are the major movements. So I make the color bright, pop, and the line thick. Change this to 50. All right, see it now, it's charted there. And 200, I leave it pink and thick as well. Take away the long, take away the cross. 200, and if you chart it right, you get this, right? So that's the EMAs. Now let me explain. EMAs. When I first started, I was using SMAs as well. And the primary difference between EMAs and SMAs is the sensitivity each one shows to the changes in the data used in calculations. SMA calculates the average of price data, while EMA gives more weight to current data. So EMA is more current, SMA is a little bit behind, but they're both lagging indicators, right? So, but another funnier way of I explain EMA, since it spells out Emma, right? I would tell my friend, when you first start trading, do 50 and 200, and then focus on 50 crossing up as a bullish signal for Emma, right? This girl, I told my friend, Emma is a girl that she could either be the girl of your dreams, right? You meet her right here, you meet her here, she makes you happy, and then you reach a point of your life where you and Emma are so happy. She gives you all these things, all these gains, but then eventually she starts to flip, right? So the relationship gets toxic. So once you start noticing Emma start to flip, human nature sometimes we like to stick around because we enjoy getting hurt or getting dragged down, right? So I tell him, once you notice Emma curving back down, yellow line going back down to the pink, you better leave. You better leave that girl because she'll take back everything she gave you from here all the way down here. And she'll drag you down with it if you don't leave. So that's a funny way of me explaining what Emma is. Emma is a girl that you want to be with when she brings you up, and a girl that you want to leave when she brings you down. So, yeah, that's one way of explaining Emma. And then the next indicator that I use is MACD. Now I don't really change numbers on this, but I do change the colors. So to change that, you gotta scroll over here, change the settings. I leave everything as is, but the only thing I change is histogram is this volume over here. All right, so this is change it to green, make it thick, so I can see the volumes by and sells. And then MACD is my signal line. Well, MACD is MACD, and then I change that to green because that's my buy signal. And then the signal line is red because it is the bearish signal, right? Okay, so to explain MACD in the simplest terms, so if you notice, MACD has a 0 over here, right? And this MACD basic, okay, first, in technical terms, MACD is moving average convergence divergence. Big word, right? But its purpose is actually pretty simple. It can be used in several ways. The most common ways I use it for is the crossovers. So, as I mentioned, there's a zero line here. Anything below it is negative, anything above it is positive. So we're in the negative side. What I look for is the MACD, the green line in the bottom, and it's about to do a bullish cross above the red line. And as long as you're in the negative zone, below 0, that's a buy signal. So don't buy. So if you're up here, right? If you're in the positive, you're above the green. I mean, you're above the histogram, and then you see this thing forming, like it crossed. You never do a buy signal above the 0, the positive side. When you're a positive side, you never do a buy signal, just because this is anything above this is a bear call. So you only do buy signals, or you're only bullish when it's about to do a bullish cross when you're below the 0. And the green is about to cross red. And the histogram I use as volume. So when it's below the 0, this is all the selling volume right here. And then eventually when it dies down over here. So we use this example. So there's been a lot of sells, right? Since the trend's been going down. And if you notice where it's about to cross, all the sell volumes are going down. And then the buy volume went above the 0. And that's how you track it. So since we talked about the bullish call on MACD, the bearish call would be when you're above it, right? When you're in the momentum right here, the price swing right here. So if you did a call, you entered right here, it would have been perfect call for you. So you write it out. Once you start noticing the green line crossing back down, the red, that's when you get out. See, as you can see, once it crossed over, and you have to be in the positive side, above the 0, to do a bearish call. So if you shorted right here, yeah, if you held for more than 3 weeks, it would have been the right call, because you would have got faked out right here, but then it formed a lower low, and then it started tanking. So it would have been a good call if you wrote out the pain of getting faked out here, because if you did a bearish call and then it went up, you're like, oh shit, I got faked out, right? It's gonna go up. But if you held on, you would have made money on a bearish call because it went all the way down. till over here. So that's the basics of MACD. The next one I use is RSI. Okay, the only thing I adjust with RSI is the color. I need it to pop out more. Just made it thicker. Two things to master the RSI. 2 words: overbought, which is when it hits around 70. Oversold, when it hits below 30. Okay, so anything, if you're trying to enter the market, anything below 30, or if it hits 30, most of the time it just touches 30 and it starts rebounding, as you guys can tell over here. See, most of the time, once it hits 30, it just rebounds, right? But same is true where if we're in a heavy, strong bear trend, it can go below 30 and tank even more. So if you can get in an entry, a call entry, like 19 or even 5, I've seen RSIs dip as low as 5. That is a good entry point. All right, so again, anything below 30 is a call, is a good entry, and you match it up with the MACD. So let's say this crossover right there, and it just touched 30. Actually, that's a bad example over here. So here, the price tanked all the way to 30, right? And then it bounced back up, but the MACD is still down. Once the MACD crossed over, you see the RSI jump back up. So I would always check MACD, then RSI, and then price action. So anything below 30, you get in. Anything over 70, you get out. So there's 70 is when it's overbought. And this is the level whenever there's a bull run, this is when I get nervous, right? Whenever I see the price hit 70 RSI, I'm like, you know what, it's time for retracement. As you can see, it hits just a bit over and then it starts going back down. Hits over and starts going back down. Like the way I use RSI is if I see it make a high here, then a lower high, then that means the momentum is getting weaker. But if I see RSI of, see over here, where is it? Where's a good example? Sometimes you'll see the RSI hit double tops, but then if the next one is a higher high, like right over here, it did a double top, but then the next high is higher than this high, you'll see the price take off. So yeah, those are the basic introduction to the indicators I use. Again, these things just all they do is give you a better idea of when to enter and when to exit. All right, do not take these as a guarantee for your trades. There's a lot of fake outs that you have to learn and understand in the market, that you have to experience before you become a successful trader. Now, I also just want to say 3 things. There's 3 things that you need to master when you want to trade. All right, and those 3 things are: you got to learn how to be patient. Sometimes when let's say the 1 hour chart looks bullish, right? So let's see the 1 hour chart. Right now the 1 hour chart is trending really nice. Higher lows, higher highs. But you see the MACD is going down. This is a hidden divergence right here. So once this MACD starts going like this, the green crossing over the red again, and we're still forming higher highs, the trend will continue. But if you do put a trade, right, let's say you went over here on the hourly chart, you were expecting it to cross over. Sometimes it takes longer, it'll drag down, it'll keep going back down. So just because you made a call on the hourly chart, sometimes you have to wait for hours, more than like 3, 4, 5 hours for it to actually to actually hit the price that you're trying to get. What I'm saying is sometimes don't expect the return right away when you're trying to use these indicators. It takes time. And then that's one thing. Patience. You got to put away your pride. If you're losing on a trade, cut your losses, because the thought of thinking, oh, it's gonna reverse, will only diminish your profits to like zero. If you're in a loss already, you lose far more than you've already lost if you were to sell earlier. Get the mentality of thinking, oh, it's gonna reverse. Cut your losses. Be disciplined. Be very disciplined when you're a trader. And yeah, and the last thing is emotions. You can't be emotional when you're trading. You can't be emotional. You put that away. Discipline, patience, pride. Actually, yeah, that's 4, right? So you gotta be patient. Put away your pride. Don't play with emotions. And what did I say? What's the last one? I'm losing my train of thought here. Oh, what? Patience, pride, emotions. Oh my god. Patience, pride, emotion, and discipline. Yes, discipline. You have to be disciplined. All right. All right. Well, thanks for listening. Hope you enjoyed this this episode. Basically, just giving you the basics, right? And like I said, all these are just use them as tools. They're not guaranteed wins, but they'll help you find good entries and good exits. All right. Thank you.